All right, let's kickstart today's program with a chat on the strategy you should employ when you're investing in equity. Now, a lot has happened in the recent past, most of it related to geopolitical tensions, but that has caused turmoil in a lot of markets, not least of which the equity markets. You've also seen commodity prices globally rising, raising fears of inflation, and that in turn is expected to result in a rise in global bond yields. Now, how should you position yourself in the near to medium term in terms of strategy? Let's bring on board Karthik Javeri, founder and director of Transcend Consulting India Private Limited. Thank you so much, Karthik, for taking the time. Always a pleasure speaking with you. Let's talk about value and growth, and then we can get into the details of how one can employ this, at what time one should use either of these, and whether one can use a combination of the two. Let's start with growth first, because I think that's the kind of strategy that a lot of people have employed during the bull run that we've seen. How would you describe growth as a strategy?
You know, Alex, the truth be told, during the pandemic time, a lot of people, when the way they got into the stock market is actually the basic assumption that the stocks are quoting at absolutely, historically low valuations, very, very mouth-watering valuations. So get into those stocks and then, everybody makes money as a result of that. But so the growth wasn't really happening there. If at all, the growth was really going, downwards or sideways, right? But talking about growth, the subject that you mentioned, we are talking about companies here which are growing at a much faster pace than they grew before, number one. Number two, they are new companies, and because they are new and they are young, they are growing at a blistering pace because they have a new product or a new solution which is pretty much capturing the market. And as a result of which, the revenue growth, that is the sales growth, your quarter on quarter could be as much as 30%, 40%, 50%. These companies immediately give you the benefit of increasing share prices. So if you are very closely and very diligently, if you are monitoring quarterly numbers, you will see that the moment there's a jump in quarterly profits, eventually the stock price will also catch up. So that's basically what's happening with growth. When there is growth, automatically profits will follow. If the profits don't follow, then the stock gets hammered. But otherwise, if the growth is there intact, if profits are also fair, then growth keeps happening, stock price keeps moving up. Now, I just want to make one tiny point here. Sometimes you could have a company which is growing by 50%, but if the profit is not proportionately growing, or if the profit has reduced, then that's a red flag. You may not want to consider that as a real growth company, because growth only doesn't mean sales growth. It also means growth of net profit, which is the earnings per share, if people are monitoring it a little more deeply. It also means marginal increase in return on equity, and return on equity is either maintained or keeps going up.
Okay, so you've explained very nicely, I think, Karthik, how growth works. Before we get into the value strategy, one would think that you should also deal with the drawbacks associated with growth. While it is a well-established strategy, are there any drawbacks to going with this one approach?
The fundamental thing, now if you go by this doctrine of growth, perfect examples are, these e-commerce websites and e-commerce ventures which have got recently listed. Their growth is phenomenal, and that's why they keep getting more and more rounds of funding by private equity investors and angel investors and so on and so forth. But are they making profit is the question. So what happens in a bad time when the tide turns around? These stocks get hammered completely and endlessly. Because look, what are we actually paying for as an investor? I am paying for having a partnership share in the growth of that company. I'm being the owner of the company when I'm buying a stock. So if there is a stock which is only showing me sales at the cost of burning money and spending a lot of money, but if they are making no profit, then that's a red flag for me. And the moment the interest of some of the people who are chasing it, maybe large broking houses, maybe somebody is exiting, there could be lots of strategies going on behind which ordinary people like you and me will never understand. So when that activity is over, and it's happening right now as we speak, some of the darlings and some of the best known or touted as the best business models, look at the share prices. They are absolutely down. They are down more than 50%. So think, if you bought those companies at those valuations, how much money erosion has happened. And when will it come back is anybody's guess. I can't say that for sure. So that's the biggest negative. Growth at the cost of profit, by sacrificing profit, by sacrificing growth in EPS, all of that doesn't work out. Ultimately, it's the old age wisdom that the Gujaratis and Marwadis of the world believed. If you do business, there has to be profit. If there is no profit, a very big question on the sanctity of that business model and that investment for the retail investor like you and me.
Should look for growth companies that have strong earnings. And that, I think, was the traditional definition of the theory also. But let's talk about value, because this is something that is relatively harder to hit, right? Because the strike rate when you're talking about getting a value strategy right is not necessarily very, very high, but the payout can be significant. How do you describe the value strategy?
Very rarely this kind of large payout will happen, like you mentioned. Now, what happens? What is a value strategy? Fundamentally, it's a low priced stock, or a stock whose basic value, let's say book value, for example, is say 10 rupees. But with the current situation, the book value is 3 rupees. So you would call that this is like a deeply undervalued stock, just by using this one parameter. Does this happen? Yes, it happens for a fact, and it happens with many companies at many times. Assets are large, profits have happened, they have accumulated, and from an accounting point of view, book value is at 10 and the stock could be at a 3 or 4 at the moment, which means it's a great buy. You see, that's one of the ways of looking at it. Then price to earnings ratio. If the industry, if the competitors of that company that the company is working in, the industry or the sector that they're working in, if the average is say 20, and if the company that you're looking at, if that P ratio or price to earnings for that is about 5, then again you would say that that's an undervalued stock. But A, hard to define, and B, a lot of times stocks are undervalued because they are maybe a utility company, or they are just doing the same thing year after year, because they are going to maintain their balance sheet, but they are not going to have a huge growth in sales. So the earnings will continue, the dividend payouts will continue, but capital appreciation will not happen so much. It happens in many public sector companies also, that we see that sometimes the valuation could be really, really cheap, but you would never really make money out of it. It's not a wealth creator, because that company is not interested in going and making new acquisitions or making inorganic growth or anything of that sort. So there are lots of ifs and buts that happen with the value strategy. Sometimes, like you said, the rewards work out. You identify a gem, and you feel that, and the value strategy actually comes out in times of depression, in times of a crash, where there is an exuberance of everything. So when the markets have fallen, sometimes even the good guys get beaten very badly, right? And in that sense, when a good company you find at a very, very low valuation, then that's the time the value strategy will work. But otherwise, most of the time the market is in a trend. It's in a broad trend. I'm not talking of a short-term trend, but I'm talking of a medium to long-term trend. And the trend is normally upwards. So in an upward trend, it's so hard to find value sometimes. But that said, it's not a bad idea. And one must look at some of these parameters so you know what price you are paying. Sometimes you don't want to pay an exorbitant price, but sometimes you want to pay a reasonable price for somebody who's growing at that speed.
Reasonable is subjective, isn't it?
Yeah.
It is subjective. It depends on who is buying and what they think when they're buying, for what horizon they're buying, all of those factors. But having said that, let's talk about the current scenario, right? Where we are at right now. There's so much volatility, there's so much uncertainty. There are even people that are suggesting that it is time to turn to a value strategy from what has been a growth-oriented strategy more often than not. What would you say in terms of how an investor here in India should approach things?
Alex, on literally an everyday basis, we are continuously seeing the profiles of companies. When I say profile, means we're not reading balance sheet, but we are looking at the numbers. So we're looking at which company has been growing, whether there is growth or not. And what I have concluded is there is not one, not two, but there are dozens of companies and dozens of opportunities which are growing at a rapid pace, which are growing at 30%, 40% quarter on quarter. So, I mean, quarter compared to the last year's quarter, that's how I mean. So there is enough opportunity, there is enough growth. We are in a long-term bull market. What happens is after 2 years of the markets rising, we are falling right now. But this fall is not going to be like a global crash or a catastrophe, what happened 2 years ago or what happened in 2008. That kind of an event happens once in a decade or once in, say, about 8 years' time. So 2020, it's happened. I do not see such a huge crash happening. These are corrections, and corrections sometimes could be larger. And corrections also can be in the range of about 20 to 30%. That's the historic average of the last 30 years of our markets. So therefore, I think we are still absolutely intact into the growth model. If that were not true, companies would not be growing. There are enough and more examples of phenomenal sales growth, phenomenal profit growth, and therefore that growth model is very much live and kicking at the moment. If you go to value, then you might actually miss out on the opportunities. I mean, look at what's happening in the sugar sector. Continuously there are announcements, there are opportunities, there are lots of things happening. A sleepy sector, a value-oriented sector which is transforming itself into a growth sector. Infrastructure, there is so much of supply and demand imbalance in the global economics. That is playing out. China plus one is playing out. There is so much happening. So yes, we've gone up 150%, Alex. We should come down by about 20, 30%. I think that just makes the whole market participation a lot more healthy. That's fine. Long-term investors are not worried because their profits are moving up and down. New investors, go cautious, go step by step into this. But at the end of the day, everybody is going to make a lot of money. There's a lot of opportunity. And I think the growth strategy is very, very much intact. I don't think that's going anywhere too soon.
Okay. Now, the last word, Karthik, in case, and there are a lot of investors out there that are venturing into the stock market themselves, but a lot of investors that still go through the mutual fund route. And there are mutual fund managers that have either a growth approach or a value approach. What would you say in terms of advice where people should know what the orientation of the AMC or the fund manager is?
I think people sometimes overanalyze the details of investing into a mutual fund. So you go to a couple of mutual funds. You can choose, I mean, if you really understand the difference between value and growth, by all means do that. For all you know, in about a year or 2 years' time, the fund manager itself would have moved on to another company, and that strategy sort of goes under a transformation of sorts. So my sense is don't do too much. What is important for a new investor is invest regularly, keep your nerves, don't listen to all the noise and get nervous, get panicked. Don't press the sell button, especially in a falling market. Please understand, 20-30% is a normal nature of the market. That's how the market moves. So invest your money, keep it there, regularly do it. If you see that somebody has consistently not performed over the next 2 years or 3 years, maybe you want to exit. But even if you are looking at the general portals which are available, the comparative analysis that you get if you look at the consistency of a fund on a 3-year, 5-year, 7-year, 10-year basis, let them decide what strategy they want to have. Let them decide their investment model. Let them decide what they want. Ultimately, you're interested in whether they make money for you. If you are making a 15% compounded return over a 15 to 20-year, 25-year period through your working life, I don't think there is anything to worry about. Let the professionals do their job. You focus on your skills and try and earn more and invest more.
No, thank you so much, Karthik, for joining in, for taking the time. Always a pleasure.
Oh, thank you. Bye.